Hello, everyone, and welcome. As we look at the markets today, Sunday, November 2nd, 2025, regular trading is, of course, closed for the weekend. We're looking at Opendoor Technologies, ticker symbol OPEN, which finished the last trading session on Friday, October 31st at $7.77 per share. That was a very strong move, closing the day up 5.86% with a fractional gain after hours. Now, a jump like that heading into the weekend gets a lot of people talking, but the real story, the one that truly matters for this company, isn't that 5% pop. The real story is what's happening this coming week. Opendoor is scheduled to report its third quarter 2025 earnings on November 6th, and they are completely changing the format. They're calling it an financial open house, live streaming it on platforms like Robinhood, X, and YouTube, and pointedly taking questions directly from retail shareholders. This isn't just a simple update. It's a calculated signal from a new management team that they understand exactly who is driving their stock's narrative right now, and they are preparing to make their case directly to the individual investor. The common belief, the general expectation for Opendoor has always been fairly simple. It's an iBuyer. It's a high-tech house flipper. The company's fortunes are seen as being chained directly and entirely to the direction of house prices, and even more critically, to the cost of capital. The stock's stunning 388% rally year-to-date is widely interpreted as a simple, leveraged bet that the housing market has bottomed and that the Federal Reserve's recent rate cuts will refuel the fire. The expectation is that Opendoor is a cyclical real estate company that buys low and sells high. But the reality of what this company is becoming is now profoundly different, and this is where the market is completely divided. Opendoor is in the middle of a radical strategic pivot. This is no longer just an iBuyer. The company just brought in a new chief executive, Kaz Nejatian, an executive from Shopify, and the founders, Keith Rabois and Eric Wu, have rejoined the board, injecting $40 million of their own capital. Their stated goal is to transform Opendoor into an AI-first real estate platform. The old expectation was that Opendoor buys your home. The new emerging reality is that Opendoor wants to be the platform that facilitates the sale, partnering with agents through its key agent program. This is a strategic shift from a capital-intensive, balance sheet-heavy model to a capital-light, high-margin platform model. This pivot changes the entire risk profile and the fundamental valuation case for the stock. That 5.86% jump on Friday wasn't happening in a vacuum. It was almost certainly a mix of pre-earnings anticipation and a direct reaction to the fantastic news on the macroeconomic front. The average 30-year fixed mortgage rate has just fallen to its lowest level in over a year, dipping to around 6.17 to 6.25%. This is a powerful tailwind for the entire sector. It makes Opendoor's inventory cheaper to hold, and, more importantly, it unlocks affordability for the end buyers they need to sell to. But this is where the real tension lies, and we saw it in their last report. In the second quarter of 2025, Opendoor achieved a milestone that many thought was impossible. It reported its first quarter of positive adjusted EBITDA since 2022. This was a huge headline-grabbing win. But here's the reality behind that number. They achieved it by shrinking. Home acquisitions, the core of their old business, were down a staggering 63% year over year. They proved they could be profitable by slamming the brakes on growth. Now, management has already guided that for the third quarter, the one they are about to report, revenue will likely decline sequentially, and they expect adjusted EBITDA to slip back into negative territory. This is the critical conflict. Can Opendoor successfully pivot to its new capital-light platform model before the cash burn from its legacy inventory and slowing transaction volume becomes a serious problem? The positive Q2 EBITDA was the expectation. The negative Q3 guidance is the reality. Now, we have to talk about the other side of this trade, the enormous pressure building against this stock. Opendoor is, without question, one of the most embattled and heavily shorted stocks on the entire market. As of the last official report from mid-October, the short interest stood at a staggering 161.1 million shares. To put that in perspective, with total shares outstanding around 736 million, and a large portion of that held by insiders and institutions, this means a very significant percentage of the public float, easily over 20%, is being actively shorted. These are not small bets. This is a massive, coordinated position from investors who are betting the company will fail. Their thesis is straightforward. The stock is fundamentally and hopelessly disconnected from reality. While the stock has rallied 388% and trades at $7.77, some analyst consensus targets place its fair value at a grim $1.71. The short sellers are betting that the positive Q2 EBITDA was a one-time fluke, a statistical blip achieved by financial engineering and shrinking the business, not a sustainable trend. They're looking at the company's balance sheet, its cash burn, and the fundamentally low-margin, high-risk iBuying model, and betting that it simply cannot survive in a volatile housing market, even with slightly lower rates. For those of you watching this, you have to understand how to track this information responsibly. You can find the official short interest data published by NASDAQ twice a month. This tells you the exact number of shares short, but a key metric to look at next to it is the days to cover ratio. This is calculated by dividing the total short interest by the stock's average daily trading volume. Now, for Opendoor, this number is surprisingly low, often reported at just 1 day or slightly more. Why? Because the stock's average daily volume is incredibly high, frequently exceeding 160 million shares. This is a critical distinction. This high-volume trading actually cuts against the potential for a long, drawn-out Volkswagen-style squeeze where shorts get trapped for days. The high short interest here is not a technical trap. It is a pure, directional, fundamental bet that Opendoor's business model is flawed and its stock price is a bubble. What's your read on this massive short position? Is it smart money correctly identifying a 388% rally that got ahead of itself, or is it a fundamental misunderstanding of Opendoor's new AI platform pivot? Let me know your thoughts in the comments. This creates a fascinating and dangerous divergence. While retail enthusiasm is clearly high, stoked by the new CEO, the AI narrative, and the direct appeal of the Robinhood earnings call, the smart money is not universally convinced. A look at the 13F institutional filings from 2025 shows a worrying trend. Some of the largest asset managers in the world, including giants like Vanguard and BlackRock, have been significantly trimming their positions in Opendoor. This is the definition of a battleground stock. You have a massive, enthusiastic retail investor base buying into a future-facing tech story, while at the same time, a significant portion of the institutional world is quietly heading for the exits, and an army of short sellers is digging in for a fight. This is a clash of narratives, the AI platform of the future versus the cash-burning house flipper. Everything, and I mean everything, now hinges on this November 6th earnings call. The market has already priced in the expectation of weak third-quarter numbers. Management already told us to expect that. So the stock's reaction will not be about the Q3 revenue or EBITDA figures. The reality that investors will be desperately searching for is proof of the new model. They don't care about the past. They care about the future. They will want to hear the new CEO's plan laid out in granular detail. They will want metrics, any metrics, on the key agent program. How many agents are on the platform? What's the conversion rate? What is the revenue per partner? They will be listening for a clear, believable, and data-backed path to sustainable profitability, not just a one-off positive quarter achieved by cutting the business to the bone. The primary catalyst for the bull case is this new capital-light AI strategy supercharged by the tailwind of falling mortgage rates. The primary risk for the bear case is that this new strategy is just talk and sizzle, and that the company's cash burn from its existing aging inventory of homes will continue to drain the balance sheet before the new model can ever get to scale. With the new CEO from Shopify and the pivot to an AI-driven agent platform, what do you think Opendoor's revenue will primarily come from in 2027? Direct home sales or platform and service fees? Comment below with your take. So as we head into this pivotal week, that 5.86% gain that closed the week at $7.77 is just the quiet before the storm. It's the market placing its final bets. The common expectation is that Opendoor is a simple, leveraged bet on the housing market. The much more complex reality is that this is a company in a high-stakes, public race to completely reinvent itself. It is a high-tech platform narrative clashing directly with a massive fundamentals-based short thesis. This upcoming earnings call isn't just about a quarterly report, it's a test of whether this new management team can convince a deeply skeptical market that Opendoor has truly changed its business model for good, or if the short sellers are right and this is just the final optimistic surge before a painful return to earth.